rigtig mange investorer hos Nordnet interesserer sig for. Og derfor har vi inviteret Shannon fra Alliance til at give en præsentation. Så vi switcher lige over engelsk nu og kører præsentation på engelsk herfra. Hello Shannon, are you ready to do your presentation?
Hi, good morning everyone. Hi Brian.
Good morning.
I am. Let me start my video.
Thank you so much for being here with us. And I hand it over to you and do a presentation and we do a Q&A after your presentation.
Sure. Thanks a lot. Hello everyone, this is Shannon from Alliance Global Investors. I'm the Senior Product Specialist specializing in China equity space. So today, as you can see from this title, I'm giving you an update on our Alliance China Equity, which is the fund that we're managing for Danske. So today's presentation, I have around half an hour, so I'll break it down to two parts. The first is really a market review and outlook, so more broadly on the overall market. And then I'll give you a portfolio update, highlighting to you what changes have been made and what are the opportunities that we're capturing in the portfolio. So let's first get started. Market review and outlook. So we all know that China has been very topical these days. I'm sure you've read from news that China is faced with a wave of tightening policies, especially targeting at internet and educational companies. And it's also exactly because of this that the offshore China index, MSCI China MSCI China index, have had quite a noticeable correction since the beginning of July. And actually, if you compare offshore China, which is MSCI China index, versus onshore China, which is the China A-shares, actually offshore China massively underperformed. And one of the reasons for this is actually a lot of the companies that are being affected by the recent regulatory tightening are mostly related to those listed offshore in US and in Hong Kong. So a lot of them are related to internet services, platform services, as well as educational companies. Whereas the company listed on onshore market, China A-shares, we don't host a lot of these similar type of companies. This is why there has been quite a strong divergence between the performance of onshore China and offshore China. Now that's the performance of the market, but what I want to highlight to you is really trying to make sense of the recent regulatory storm. First of all, why we have seen a wave of regulatory tightening, why it is happening now at the moment, and what are the expected impact for these regulatories. I know this slide is quite wordy, but I'll just summarize and quickly highlight it to you. So basically, I think the main target of these regulatory tightening is really to serve a specific domestic purpose, which is to address some of the structural economic problems in the overall economy structure. So as you probably can see, China is faced with some structural problems such as high leverage ratio, such as the aging population, and also an inequality domestically. So a lot of the businesses have been able to profit from the economic growth, whereas labor or the consumers hasn't participated as much. And also China is faced with the threat of national security on the data side, as well as the lack of competitiveness on the fundamental and basic technology side. So you could see that China, despite of its high growth, is indeed faced with these structural issues. And I think the authority is well aware of this. So a lot of the recent regulations are really targeted to solve some of these issues. For example, there has been a regulation tightening the regulation over the educational sector. Basically says private equity, all educational companies, especially those focused on in the school education, then you have to be not for profit, right? And then private capital should not participate in this part of the market. So basically that's trying to bring down the cost of education which is a financial burden that is weighing on birth rates and demographics. And another example is really, to enhance the employment rights of delivery drivers who is working for big platform companies such as Meituan, and that is also targeted to protect the labor force and bring a dose of equality back to the situation. So we could see that a lot of these regulatories, they really have a purpose. It's not really trying to crush the business and try to nationalize the business, but rather to serve a longer term, to lead to a longer term sustainable development of China. And many people will question why now? Why the regulations has come so intensive in the first half of this year, especially around July. And I think one of the trigger is really the low birth rate that came out of the 2020 population census. It was surprisingly low, so that was an urgent catalyst for new policy to help alleviate the concerns over giving birth to more kids. And also, it's also because in the first half, Chinese economy has been overall on quite a solid footing. In fact, the overall Chinese economy has been recovering at a very steady pace ever since the first quarter of last year, which was when the COVID hit the most to the country. And given this encouraging economic recovery, actually, it is a good time for the government to utilize the economic strength and introduce some of these structural reform measures so that there's a balance between growth and structural reform. And this is also why we believe going into the second half of this year, actually the economic momentum might slow down a little bit based on high base effect, as well as the recent tightening policies. So it might happen that the pace of regulatory announcement, or at least the negative surprise factor, might be easing a little bit towards the second half of this year. So what to expect the next? First of all, regulatory impact should vary from company to company. So we shouldn't view this as a negative movement for all the sectors across the Chinese economy. And that also means that for Chinese companies, they're likely to have limited access to US capital market in the future, but that will bring new businesses to Hong Kong Stock Exchange, where companies still try to be listed overseas, but just in the market that is close to home. And also equally for some of the big tech companies that are being impacted at the moment, we still believe they should generate good and sustainable growth into the future because they have very sticky user base, and they usually have strong ability to weather through different regulatory changes and find their own way of developing without really harming the interest of other stakeholders. But of course, we should expect a more regulated growth in the future. And in the near term, it's very likely that many of these tech companies will keep their heads low for the moment. So they may take this chance to do a lot more kitchen sinking and just to ensure their future growth potential. So overall, we believe the risk premium could be high in the short term, but it remains to be seen, of course, how the situation plans out for the longer term. But we do believe that overall, the logic of investing in China still stays valid, and I'll let you know, why that's the case within the following slides. So one of the key questions that actually many investors ask us when they see this wave of tightening regulation, tightening policies by Chinese government is China still investable from a foreign investor's perspective? And we believe the short answer is yes, because the fundamental logic of allocating capital towards China, from my opinion, still stays very valid. For example, Chinese capital market is developing very fast, together with supported by strong economic growth. But when it comes to the representation of this capital market within global investors' portfolios, it is still very, very underrepresented. For example, if you look at this particular slide, you could see that China's GDP is around 16% of the world. Consumption power is around 12%. Asia's percentage of overall world index is around of overall world capital market is around 11%. So all of these indicators are indicating China is actually very influential across many aspects. However, when it comes to China's capital market as a percentage of the global indices, let's say MSCI All Country World Index, which is one of the most commonly used index, China is still 5%. So it's substantially low compared to other developed markets, especially US, who is accounting for over half of the All Country World Index. So from this perspective, I believe there's still a long way to catch up for China's capital market to be a larger part of global investors' portfolio. And at the same time, China is not stagnant. So when you try to look for the longer-term growth opportunities in China, I think it's still very abundant. And even after the recent policy tightening on the internet and on educational sectors, because China is more than just the application of internet, which obviously have grown very, very strongly over the past decade, but there are still other very interesting growth areas in China, which I believe could provide a lot of interesting stock selection opportunities. For example, one of the longer term drivers of China is really the green development. President Xi Jinping has committed last year that China should achieve net zero emission by the year 2060. It is actually a very ambitious target, especially considering the current energy mix of China is with more than 80% of the power being generated from coal-fired power plants. So it's actually a very CO2 intensive way of development. But China is trying to improve really, really fast. So China is now home to one of the largest solar equipment providers in the world, and it's also expanding very fast. It is expected that by 2045, hydro, nuclear, solar, and wind should be the absolute major source of energy in China. So the country will reinvent itself to become a country that depends mostly on clean energy. And at the same time, another big consumption of crude oil is the automobile sector, burning crude oil. And what China is trying to do is really to promote the use of electric vehicles. I'm sure you've always heard about this on the news headline, but China is actually one of the leaders in the sales of electric vehicles. This country alone accounted for around 40% of total global EV sales last year, which is very, very, very significant. So along this direction, actually, we can find a lot of interesting investment opportunities, such as the electric vehicle supply chain, such as new energy supply chain, and etc. So this provides exciting growth opportunities. At the same time, the increasingly wealthy population also demands better services and better healthcare services as well. Because of the rapid development of healthcare innovation, technology, and services, we have seen a surge of healthcare stocks in China. For example, this particular page, I'm presenting to you the market cap of China healthcare stocks listed both offshore and onshore. So as you can see, over the past decade, the market cap have moved from around $200 billion to $1.6 trillion. This is driven not only by the strong growth of the companies, but also the rapid development of the sector, which is leading to strong IPO opportunities in the market. And as you can see, some of the subsegments has been really growing very fast, such as biotechnology, life science and tools, healthcare technology, etc., etc. So along this trend, we have also been able to identify interesting names that can benefit our investors. So overall, this is why we believe that it makes sense to stay invested in China despite of the recent headwinds. Of course, it's very difficult time when it's the turn of the market. But I think one thing I would like to share with you is really the longer term performance of MSCI China versus MSCI Europe. This is the performance of past two decades of MSCI China compared to MSCI European index in terms of euro total returns. You could see that indeed China has been very volatile all along the way. There has been periods of time where the market corrected by around 50%, and it has indeed been very, very bumpy. But if you're patient enough and look at the longer term, actually China has outperformed Europe by around 300% over the past 2 decades. And this is really a very powerful statement to me that it makes sense to be investing in China over the longer term. And usually market weakness can represent a good entry point for longer term investors. So that's all about the market update. Now I want to give you some portfolio update for the portfolio. So here I'm presenting to you the performance of Danske Invest Kina, which is the portfolio domiciled in Denmark. As you can see that this portfolio was incepted a little less than 5 years ago. And since inception, we've achieved, good outperformance over the past 1, 3, and year to date. We have also been able to deliver quite strong outperformance as well. And please remember, this is despite the recent volatility in the market, where a lot of stocks are being, overly punished by the market. So I think this represents our focus on quality growth stocks, which are underappreciated by the market. And usually when the market is really, really volatile, we can usually better weather the market downside. Here I want to give you an update on the portfolio positionings and its key allocations. The left-hand side might be very relevant to you. So this is the portfolio weighting across different sectors compared to the benchmark weight. Now, the first observation is actually we don't deviate significantly from the benchmark in terms of portfolio weighting. And this is because we focus mainly on bottom-up stock selection to run this portfolio. We don't do top-down allocation or very strong sector bets, but rather we focus on finding the better stocks from a bottom-up perspective. And also you could see that this portfolio is quite, in terms of absolute allocation, is quite tilted towards growth areas such as consumer discretionary, consumer staples, healthcare, and industrial. So these are the larger areas, the larger sectors within the portfolio. Of course, financials is also quite heavy. We have around 12% in financials. But remember that maybe 5 to 10 years ago, financials accounts for an even bigger part of the index as well as the portfolio. So over the years, investing in China actually is taking on very different meaning. Previously, many people regard China investment as investment into state-owned enterprises, energy companies, old industrial companies, and ex-growth financials. But nowadays, it's clearly no longer the case. So investing in China equities actually takes on a much growthier, bias compared to before. And also, if we look at the market allocation, then we'll break it down by listing locations. Let's look at the top right box. So here you could see we give a breakdown according to the listing location. And specifically, I want to point out the A shares allocation. So here you could see A shares is around 14% of the overall portfolio. And here we are growing in line with the benchmark in terms of, or slightly ahead of the benchmark in terms of our allocation towards China A shares. We don't want to run the portfolio to be completely unconstrained when it comes to market allocation. But what we are doing at the moment is that we are leveraging on our strong China A shares team to find the best ideas from China A shares and complement it to the portfolio that we can find in offshore listed China stocks. So it's really a complementary approach that we have when it comes to A-share investing. Also, in terms of market cap, you could see that our portfolio is relatively large cap biased. And I need to emphasize here is that our portfolio market cap allocation is quite similar to that of the benchmark. What they're seeing here is an absolute threshold, but in reality, compare our portfolio to the universe, we actually invest across small cap, mid cap, and large caps to find the best opportunities for our clients. Okay, here is a top 10 of the China equity portfolio for your reference, and I listed out their portfolio weight as well as the benchmark weight. So I want to point out two things. First of all, is that there are a lot of names which are quite well-known internet names, and they have been, punished quite severely over the recent sell-off. And overall for the portfolio, we do have a very clear underweight to internet space. For example, looking at Alibaba, we're underweight by around 5%. Looking at Tencent, this is the largest gaming and social networking company in China, then we are underweight by also around 5% as well. So overall, if you add up together the overall internet exposure we have compared to the benchmark, we are on a very clear stance of underweight. And of course, we're monitoring for the dust to settle, and we need to find some clear signs of turnaround of business or clarity of the recent policies before we narrow our underweight. At the same time, apart from these benchmark heavy names, we also do have interesting names which are really benchmark light, or they're even non-benchmark, but we like these names from a fundamental perspective. For example, we do have China Merchants Bank. We do have Zhongshan Group, which is the fourth in the top 10, and it is one of the luxury automobile distributors in China. And we like this company because it should benefit from the recovery of consumption post-COVID in China. Another example is Hong Kong Exchange and Clearing, basically the stock exchange in Hong Kong. We like the stock exchange because it's in a very monopoly position to benefit from the opening up of capital markets in China. For example, now we have the stock connect arrangement between Hong Kong Stock Exchange and Shanghai Shenzhen Stock Exchange, and the flows through foreign investors mostly are channeled through these stock exchanges to A-shares. And the Hong Kong Stock Exchange is naturally very well positioned to benefit from the increasing capital market opening up. So this is some of the the key names that we have in the portfolio, and hopefully that gives you some flavor of what are the names that we are owning at the moment. Lastly, I just want to give you a quick update on what are the longer term trends that we're seeing in China, and also trying to capture these in the portfolio. So here are five key trends that we identify for the moment. We do not have to always be invested within all these different trends, but I think this can give you some a good feeling of what are the kind of companies that we're trying to capture for our investors. For example, one of the trends is called self-sufficiency. It basically means China has a strategic need for self-sufficiency in key areas. For example, 5G, semiconductor manufacturing, renewables, etc. And these sectors are very likely to receive future policy support. And the importance of self-sufficiency actually has been enhanced over the past few years as the China-US technology conflict were on the rise. The second one is called industrial upgrade. It basically means with the improving quality of Chinese manufacturing, we are seeing a lot of companies are rapidly upgrading the quality and technology of their products, especially in the industrial sector. And these companies are winning market share from other local players, as well as foreign players within domestic market. So this industrial upgrade also creates a lot of potential leaders in the future, which we can capture in the portfolio. The third trend is called healthcare and biotech. I don't have to explain too much, but this is very intuitive, right? As people desire better healthcare services in China, then the demand basically also incentivized the surge in biotech spending over the past decade, and now we're seeing a much widening range of investment opportunities. We do not only have very old-fashioned generic drug making, generic drug pharmaceutical companies. We also see a lot of very innovative biotech companies, clinical research organizations, for example. So these are all very good potential investment targets for the portfolio. And of course, we can't emphasize more about the importance of renewable energy. I mentioned in the presentation earlier, China is trying to achieve net zero emission by 2060. So we should expect significant investment in areas such as solar, wind, electric vehicles, and etc. And last but not least, it's a trend that may come across as very familiar to all of you. It's called a consumption upgrade. So this is, despite it's a very old-fashioned trend in China, but this is continuing to happen in China, but it might take a different meaning. So previously, it basically means upgrade from very basic necessities to higher-end brands, or to buy more home appliances, buy more cars. But in the future, it's not only about buying more and buying better. It's also about spending to increase the happiness of life. It's about lifestyle upgrade. So basically, we're seeing increase in domestic traveling, increase in spending on domestic brands, increase in tourism sites, for example. So these are some of the very interesting investment opportunities that we will capture in the portfolio as well. So that's all about the portfolio update. I think we are running close to the half-hour mark. So I wanna summarize today's key points for you. So first of all, the recent events of policy tightening is a reminder that investing in China brings potential higher returns, but also comes with higher levels of volatility. Second point is China still requires foreign capital to meet its strategic economic goals. So the recent policy tightening should be more of a short-term speed bump in the opening up of China's capital markets, but should not derail the underlying development and the underlying logic of investing in China. And finally, our China equity portfolio focuses on structural growth names that are underappreciated by the market. And as I've mentioned in the previous page, we see this structural growth coming from renewable energy, self-sufficiency, industrial upgrade, biotech and healthcare, as well as consumer areas. So that's all for today for the part of my presentation. Happy to open up for Q&A. Thank you.
Hello, I'm back. Thank you so much for a great presentation, Sharon. You actually, the summary, I was trying to do that as well, but you did it so good here. So volatile for the short term, but you see big potential in the long term. Some question is about, I can see you have underweight in Alibaba and Tencent, and that was quite clever this year, and maybe support some of the good performance this year. But what do you see as at the biggest risk? Do you think the fall is enough now, or do you see what is the biggest risk concerning Alibaba and Tencent and maybe the rest of the shares?
Well, actually, I think the biggest risk for all of these internet names is really the policy overhang. Because the policy, we shouldn't interpret the policy on a standalone basis. So we have 5 policies, and we try to just examine each area of them. But rather, I would encourage investors to link them all up and examine why there is what is the fundamental reason for this policy tightening. As I said before, it's really about adjusting social inequality. making sure that these internet companies are not using their monopoly situation to exploit the benefit of consumers or exploit the benefit of small merchants, right? Basically making sure they're not too big to be punished. So I think that the policy overhang is still there in the near term. A lot of these companies are also trying to gauge the boundary of where the policy is. We're also monitoring this very closely, but we don't have a crystal ball, so it's difficult to tell the exact next step of these policies. But for example, if there is more concrete penalties that in monetary terms, or concrete directions of what you can do, what you cannot do, I think that's when investors will get more clarity into the future for these companies. But as I said, I don't think the purpose of the policy tightening is to kill these companies, right? It's a bit like educational stocks, where they are actually not, they're not the data infrastructure, or the infrastructure and utility provider in China. The country can't afford not to have them. But then for Tencent, for Alibaba, almost all Chinese, use some of their services. So you really can't kill these companies, but you have to make sure that they can grow in a more reasonable range. So the previous, 50-60% of growth is very difficult to be repeated in the future. And some of their applications might see a difficulty to be monetized rapidly. So this is what we believe they will still grow nicely in the future, but at a more moderated level.
Okay, I have one more, because the last 3 years you have a good solid performance relative to benchmark. What are your thoughts about what are your how do you perform better than the benchmark in the future as well? Whether you see the biggest sector, do you keep your overweights, or do you have something in mind for the next 3 years maybe?
Actually, the biggest source of return or alpha for us has always been stock selection. So we don't try to time the market with adjusting cash, nor do we try to bet which sector will massively outperform into the future. And with the recent policy tightening, you might sort of understand that no sector should be completely risk-free, especially compared to the policies. This time around, it's about internet allocation. Actually, a few years ago, we had rounds of tightening on pharmaceuticals. Previously, it's on real estate, and before it's on banking, shadow bankings, right? So these kind of policy storms comes in every 2 to 3 years to the market. So from our perspective, then it's really to try to focus on our stock selection and compare companies with a similar. First of all, find companies where we see their structural growth potential, benefiting from the longer term growth trends within China, and then we use bottom up fundamental analysis to gauge which stock should be the winner of the future and capture these stocks in the portfolio. Because there are a lot of risks in the market where we cannot fully control, and what we need to do is to really mitigate that part of the risk and focus on areas where we're good at, which is stock selection.
Yeah, thank you so much. So good handcraft on each company. That's the way to do it in the future as well. Okay, thank you so much. No further questions, and thank you so much and for your presentation, and maybe I'll call you in later on in a few years.
Sure. Thank you for having me. Have a nice day, everyone.
Bye-bye.
Bye.